To the beautiful cradle of the Middle Belt, a land of heroes, a friend to everyone. North, south, east, and west, a land of great wealth, rich in food and rich in livestock. A tourist delight, a state so endured, yearning to be exploited. Full of love and friendship. A people with strength and character. A people full of devotion. A people determined to succeed. Let's build our plateau, let's unite and be one. So let us shake hands. You're my brother, you're my sister. North, east, south, and west, oh plateau, arise. Arise, let's sing one song of peace. Plateau State, beautiful Plateau State, beautiful Plateau State, beautiful Plateau State.
Pleasant greetings to you. This is Business News coming to you live from our Rayfield studio. My name is Karen Lucas. On the news this morning, in a strategic move to curb rising food and fuel prices, the Central Bank of Nigeria has tightened its grip on the financial system, pushing the interbank deficit to 4.1 trillion naira by vacuuming out excess liquidity through high-yield government bills. The Central Bank of Nigeria is betting that a short-term drought in the banking system is a necessary sacrifice to stabilize the naira and prevent inflation from spiraling out of control after its recent jump to 15.4%. According to the latest AfriInvest weekly market and economic analysis, the interbank system of resurgent inflation and exchange rate volatility. The report reveals that system liquidity conditions, representing the volume of discretionary cash available for banks to lend to one another, remain deep in negative territory. While the average system deficit narrowed by 18.17% to settle at 4.1 trillion naira, down from 5.0 trillion naira the previous week. The figures signal a deliberate drought orchestrated by the regulator to mop up excess money supply. Analysts at AfriInvest noted that this persistent shortfall is not accidental, but a core feature of the current fiscal defense strategy. To anchor inflation expectations and prevent excess naira from chasing limited foreign exchange, the CBN utilized open market operations. By offering 600 billion naira in high-yield OMO bills, the Central Bank of Nigeria effectively mopped up cash from the banking system, locking it away to prevent it from driving up general price levels. The Nigerian naira maintained its momentum in the foreign exchange market on Tuesday, April 21st, 2026, as trading opened with a focus on narrowing the gap between official and informal rates. Following a relatively stable start to the week, the local currency continues to benefit from steady oversight within the official window and a balanced supply of foreign exchange. In the Nigerian foreign exchange market, NFM, the naira was quoted at an average rate of 1,345.47 per dollar during early morning operations. This reflects a marginal appreciation compared to the closing figures of the previous session. Market data indicates that the naira touched a brief high of 1,345.87 before settling, as interbank turnover remains healthy. The continued stability in the official window is largely credited to the central bank's ongoing commitment to a transparent price discovery process and sufficient liquidity for eligible transactions. The parallel market has mirrored this trend of relative calm. In major trading hubs across Lagos, Port Harcourt, and Kano, the dollar is being exchanged at rates ranging between 1,390 and 1,405 per dollar. While the black market still carries a premium, the volatility that once characterized this segment has notably subsided, providing a more predictable environment for retail buyers and small-scale importers who rely on informal channels. Financial analysts suggest that the current market behavior is a result of positive sentiment regarding Nigeria's external reserves and improved dollar inflows from foreign portfolio investors. The convergence of rates remain a primary focus for monetary authorities, and today's performance suggests that the market is moving toward a more unified structure. Now, Nigeria imported about 61.7 million barrels of crude oil from the United States between January 2024 and January 2026, underscoring the country's growing reliance on foreign feedstock to support domestic refining, despite being a major oil producer. This is despite the fact that Nigeria exported over 300 million barrels of crude in the first 10 months of 2025 and 55.39 million barrels in January and February 2026. Data obtained from the U.S. Energy Information Administration showed that crude exports from the United States to Nigeria surged during the period, marking a sharp reversal from nearly a decade of negligible crude trade flows between both countries. Before 2024, American crude shipments to Nigeria were virtually non-existent. The only notable supply recorded within the period was in March 2016, when exports averaged just 19,000 barrels per day, translating to about 0.589 million barrels for the entire year. However, the crude pattern changed significantly in 2024, coinciding with the commencement of operations at the Dangote refinery, which industry observers said has emerged as the primary buyer of U.S. crude to supplement domestic supply constraints. The EIA reports its data in thousands of barrels per day, meaning the daily figures must be multiplied by the number of days in each month to derive the total monthly volume. For 2024, data available for January to June indicated that Nigeria imported a total of 15.701 million barrels from the United States within 6 months. In January, imports averaged 125,000 barrels per day, translating to 3.87 million barrels. February recorded 110,000 barrels per day, or 3.19 million barrels, which, while March fell to 51,000 barrels per day, amounting to 1.58 million barrels. Now, in a decisive move to curb rising electronic fraud and strengthen consumer protection, the Nigerian Communications Commission, NCC, and the Central Bank of Nigeria, CBN, have launched a portal that enables financial institutions to track fraudulent and suspicious phone lines across the country. The initiative, unveiled alongside the signing of an MOU, which is Memorandum of Understanding between both regulators, is expected to enhance transparency, boost confidence in digital transactions, and deepen collaboration between the telecommunications and financial services sectors. Speaking at the MOU signing event, Executive Vice Chairman of NCC, Dr. Aminu Maida, said the agreement provides a structured framework for cooperation in critical areas, including payment system integrity, fraud mitigation, digital inclusion, and consumer protection. He described the development as a major milestone in regulatory coordination, noting that the increasing use of mobile numbers as tools for identity and financial access makes stronger collaboration between both sectors imperative. According to him, the Telecommunications Identity Risk Management System, TIRMS, portal will provide financial institutions with real-time visibility into the status of phone numbers used for transactions. This means banks and other financial institutions can determine whether a line is active, swapped, disconnected, or reassigned to another subscriber, he said. He added that the enhanced visibility would significantly strengthen efforts to combat fraud, particularly schemes driven through mobile channels. Maida also highlighted the consumer protection benefits of the partnership, stating that issues such as failed airtime recharges and transaction disputes would now receive faster resolution through coordinated regulatory action. Nigeria Maritime risks losing cargo to ports in neighboring countries due to persistent inefficiencies, the Sea Empowerment and Research Center, SEREC, has warned in a new policy advisory, highlighting mounting structural pressures in the maritime sector. Titled Maritime Reform at a Crossroads, data signal, export concerns, and the urgent need for execution discipline. The advisory points to concerning threats recorded in the first quarter of 2026. Although customs revenue posted an estimated growth of between 12 and 18%, operational indicators such as cargo dwell time, and vessel turnaround remain suboptimal. According to the report, average cargo dwell time exceeded 15 days, while vessel turnaround time ranged between 4 and 6 days. Exports throughout, particularly in the non-oil segment, declined by about 8 to 12% indication. SEREC noted of a gradual erosion of Nigeria's export competitiveness. According to the report, Nigeria's export ecosystem is increasingly underperforming due to delays in processing, poor prioritization at port terminals, and logistics inefficiencies. These challenges are particularly affecting agro-exports, undermining broader economic diversification efforts. SEREC identified neighboring ports in Benin Republic and Togo as growing threats, citing their lower costs, faster clearance times, and more predictable regulatory environments. Ports along the Cotonou-Lomé corridor are increasingly attracting Nigeria-bound cargo, aided by